Diageo's regional unit, East African Breweries, reported results for the first half of its fiscal year that covers the last 6 months of 2023. The company reported a 22% fall in net earnings. Revenues are up by 16% year-on-year to $415 million, but actual sales volumes rose marginally, just about 2% year-on-year. Now, weaker currencies in the region did cut disposable incomes while pushing up operating costs and raising the cost of finance. The company reported a significant rise in FX losses that went up, in fact, by over 1,000% at $14.4 million. Now, later this year, Kenya's government also intends to change taxes applied on alcoholic products. That includes raising the value-added tax rate to 18%, partly to bring it in line with the tax rates in other members of the East African Community. It also intends to raise the applicable excise duty on alcoholic products. Now, some hours ago, I spoke to Risper Genga-Ohaga. She's the Chief Finance Officer at EABL. I started our conversation by asking her about the likely impact of those tax hikes in a market that accounts for nearly 2/3 of EABL's business.
There is a real need to look at the impact of some of these changes, drastic changes like up to 70% increases on taxes are quite detrimental to business and need to be thought through quite carefully. And even in terms of KRA, if you look at their numbers, they have recorded a decline of 20% drop in spirits excise, simply because the multiple excise increases we've been seeing, in the end, they do not result in incremental collections.
Indeed. And looking at the comparison between the presentation that you had this morning and the one that came out mid last year, it was kind of interesting to look at where the inflation pain points are, because last year I believe it was 4 main areas. Electricity cost was a big one, logistics, grain and spirits. This year, though, you've narrowed it down to 3 specific issues. Fuel and electricity are still big issues, but also the cost of raw materials as well. So walk us through what happened in the second half of last year. How was the business affected?
Yeah, I think last year, one of the big pains, there were 2 really big pains other than fuel and electricity, and one was grain. We're coming back on the back of a drought that saw grain prices go up well over 30%. And then we've had in the last 2 years a shortage of ethanol that saw prices going up 61%. So those were extremely painful to the business last year, particularly the second half. And this year we've continued to see a persistence in the shortage of ethanol, unfortunately, and a further rise in prices of about 15%. Not as bad as last year, but still coming off a high base. It's quite quite a big impact on the business. And the solve to that, we think, is to fix the issues surrounding local ethanol supply.
As I understand it, things like barley, sorghum tend to be your big key inputs. With the way rain has been erratic in the second half of 2023, and to some extent, I can't recall, for example, the last time we had a really wet January with this much rainfall. Is that a concern for you, for your security of supply moving into the first half of 2024?
Certainly not on this first half, because we typically will be benefiting from last harvest. So we still have stock going into the next half. So that will probably only show in F25 if we have significant reduction in grain supply. We haven't seen it yet. We're yet to see the full effect of this December-January spate of rainfall, keeping a close eye on it, keeping the supply to the farmers, looking at whether the harvest is in line with expectations and whether the contracted purchases will come through.
Just for the sake of context, when we talk about FX losses, is it mostly local currencies benchmarked against the US dollar, or are we also talking about the Kenyan currency essentially losing ground to the Ugandan shilling and the Tanzanian currency?
So it's both, but the primary issue is the local currencies sliding against the dollar, but also the pound. We are exposed to dollar, we're also exposed to pound, and the dollar depreciation of 27% for Kenya shilling, 15% for Tanzania shilling, and the pound depreciation is even worse at well over 30% for the Kenya shilling and just about 8% for the Tanzanian shilling. Uganda has seen a pound depreciation, again about 7%, but dollar relatively stable. So you can see all the markets, anything we're importing is where the foreign currency exposure comes in. And if we're importing it in dollars or pounds, we get a big exposure coming out of that. You find that even when we are sourcing from the East African markets, we're paying in dollars. So when you do that, then it's the cost, it's the denomination of the contracts that we have that will drive that
So
impact.
like if
On the
EABL is buying something from Uganda or Tanzania, it's the contract is going to be priced in USD, not the Ugandan shilling or the Tanzanian shilling.
Exactly. We
Right.
try and push for pricing in Uganda shilling, Tanzania shillings, but a lot of the companies are exposed to foreign currency borrowing, so they price in dollars, and so you're stuck with that. To the extent that we've benefited from the depreciation of the Kenya shilling to the Uganda and Tanzania shillings, that's showing up on our top line. For instance, we've grown 16%, but organically that's only about 9%, which is still very good. But it's 9% if you remove the impact of the depreciating shilling. So Uganda, at a reported level, is 31% up, but real growth is 6%.
One of the things that I know, especially manufacturers, have been really, really plagued with over the medium term, this is over a 3-year, 5-year window, is essentially getting access to the dollars that they need. There's, of course, arguably a bit of a dollar shortage across not just the region, but essentially across the world. The Kenyan market seems to have sort of cleared that backlog, but is that still a persistent problem for you in these three markets, in Kenya, Uganda, and Tanzania?
It's a mixed bag. So Tanzania has been the one that we've seen this emerging as a real issue, where you cannot get the dollars or foreign currency when you need it. We're working very closely with the banks to get into various instruments that will enable us get foreign currency liquidity and do some hedging against the price rising. So that's what we're doing. In Kenya, I have to say we are in a much improved position. Same period last year, we were carrying dollar exposure simply because we could not find dollars. So to get them, you had to borrow. So we're in a position now where we are able to source dollars from the banks, and we're able to settle our dues when they fall due. The challenge is that there are no pricing for hedging instruments, or no reasonable pricing for hedging instruments, which tells you that we're still not out of the woods as far as the shilling is concerned.